Sir, are we audible? We welcome you.
Thank you very much.
Yeah, okay.
Yeah.
You can take it.
So, we're just waiting for one more mic. Somebody can help us with one more mic, please. So sorry, Anshuman, to keep you on hold. There were some technical issues out here. So quickly, I'll directly drift into the topic in the interest of time, because we have a team from the World Gold Council who has to catch their flight around 6 o'clock. So quick one, I'll just start with Ajit himself. In terms of history and historically, or when you're looking at the global markets, are there examples of the over-the-counter trading systems as far as precious metals is concerned, coexisting with the exchange-based ecosystems?
Thanks, Namki. Of course, OTC has been there. Over-the-counter markets have been there for quite some time, and exchange ecosystems also, like COMEX and other exchange ecosystems, have existed for quite a few years. And it bodes well that we have both the ecosystems coexist with each other, so that the trade participants can make benefit from both the ecosystems. So yes, there have been I mean, especially if you see gold ecosystem, obviously it started with OTC, and then then have a quick exchange established by Mokata back in 1900s in London. So yes, we do have a history of OTC as well as ecosystem for more than 100 years.
Anshuman, if you can hear me, the same, more or less the same question to you as well. Being a broker member on almost 36 exchanges, if I'm not wrong, your participation is more inclined towards an exchange mechanism, or is it also towards the OTC? Because we understand that both the LBMA as well as the COMEX are preferred destinations when anybody wants to hedge their precious metals price risk.
Firstly, thanks, Ramki, for the invite. Just to answer your question, I think adding on what Ajit said, I think both of these platforms have coexisted for a very long time. And our decision also as to which platform we'll be utilizing totally depends on the requirement of our clients. And essentially, we work as, apart from the own trading we do, we are also sort of market makers for our clients, providing them access to various platforms in terms of OTC and exchange. So it's a mix of both, to answer your question here.
Interestingly, I can add a little bit. In India, had gold exchanges in pockets of Gujarat and Maharashtra, whereby not pan-India, but within that community, there used to be exchanges and official prices used to get declared, and the trades used to get settled on those prices. So that's also, again, more than 100 years.
I'll just give a context to the audience as well with regards to hedging. The IFSCA had actually proposed to the Government of India and also the Reserve Bank of India to permit hedging of precious metals, which otherwise used to happen from Dubai or Singapore, especially for the Indian entities. And that's where the Reserve Bank of India has now permitted the IFSC units also to participate in the OTC model of hedging mechanism and hedging products. And apart from that, the IFSC exchanges are also permitted. So that is the basic context that we are trying to provide. So again, one aspect that we have observed as regulators is that the OTC model itself, except for the bank's participation on the domestic side, it's practically an unregulated market. So if you see a trader who's there on the domestic market, he's not hedging per se, or rather he's hedging only on exchange ecosystem. The OTC part is still probably more unregulated than an exchange ecosystem. So do you think that having both these aspects covered in IFSC will make a big difference, and also there is a possibility of coexistence between these two mechanisms in IFSC, in GIFT-IFSC?
Well, OTC, as you know, offer certain benefits of having more flexibility, a bilateral trade, and probably, if I may say so, less amount of documentation. And obviously, exchange, we all know that exchange will have its own advantages, transparency, and a proper mechanism of trade. So, if you have to ask me, OTC currently, if you see the way it is structured, okay, we have OTC, the domestic. I'm talking only about India, whereby OTC is is a predominant way of doing business in India for gold ecosystem, and that is from the physicals point of view, whereby people do take deliveries. They still for domestic use, they probably might use domestic for hedging themselves. And here, it's mainly for the imports where people are importing gold to as a progressive, the most progressive regulators, in fact, I have seen around the world, have opened up, have created a qualified jewel avenue to import directly by eliminating certain mediators. So that ecosystem now is thriving extremely well. People are using it. 70 more plus tons of deliveries have taken so far, out of a total of around 700 tons which India imports. And even the current limitation, there are certain limitations that I think, yeah, both can exist, both can definitely coexist, because it's again a physically backed exchange. So definitely there is.
Question to you, Anshuman, in terms of the market participants, who tends to move to an OTC platform and choose an exchange platform? How does it actually work in the global markets? Is it very similar in case of the Indian markets as well, or is there something very much different when it comes to the global markets in terms of precious metals?
I think, Ramki, it's a bit it's a mix of being aligned as well as being different, primarily because the scope of the geographies in which you do business are so wide that it's a mix of both the OTC and the exchange. But also, it's important to understand that what is the need for an OTC or an exchange in the first place, and who needs that. Eventually, if you look at it, the underlying objective for choosing the platform is either you have a need to hedge your price risk, or there's a need for a price discovery. Ultimately, these are the two main fundamentals, and then the OTC comes into play when you actually need the physical to settle your transaction, or because you need the physical for your own business, whether it's manufacturing or trading or whatever it is. So I think it all depends from the country to country where we are talking about. So from India's perspective, we have seen historically that the OTC has sort of suffice the needs of the market, because it's a country where we all consume gold. We need physical gold, so it works well. We have domestic exchanges which do offer us a price discovery mechanism. I think it's always a mix of two. It's very difficult to say who goes where, but historically, if you look at it, it would be the miners, it would be the producers, it would be funds would go to exchanges. Of course, now, as we all know, the price of gold and everything related to that is driven largely by the futures, and that's why the concept of EFPs has become so prominent. So EFP is the exchange for physical. So ultimately, at the expiry of the contract, you would expect logically that the OTC and the futures expiry should converge. So that's where it comes to.
With regards to exchanges and OTC, now what we have enabled is all the three of them. And this question is to Ajit. We have seen the bullion exchange in GIFT City coming out with their futures contract. We also have another exchange, India NX, also having its futures contract. Today, Mr. Ashish Chauhan mentioned that there is a requirement of gold futures on NSE as well. So What do you think about these developments? So does it mean that there's a possibility of fragmentation of liquidity, considering the fact that you have OTC players, you have three exchanges also coming with their own products? Are these possibilities?
Uh, it's basically creating avenues, and yes, this is a, I would, if I, I have to put it, this is an enclosed kind of ecosystem where entry is, from a domestic perspective, is restricted as of now. Okay, from a domestic perspective, but now this is an international territory, an India international bullion, call it. So yes, I mean there is a, for initial stages, yes, there is. It's absolutely logical to depend on the domestic volumes. Absolutely fine to get the traction. But what we are supposed to target, or what we should do going forward, or hence, is international market. An international market. I mean, I'll just give you an example. COMEX, for example, 22 million ounces get traded every 6 months. If I have to give you an example of London market, the OTC market, 50 million ounces. Now just imagine if that, if people are given an opportunity to hedge themselves, COMEX, more or less, it's, will use it for either speculation, more or less, because deliveries are less. If we take that as a canvas, take that as our market, then I think yes, there is a scope for everybody to exist out on future. Why not? Then we are targeting, an truly international players, and not only that, that actually will help us achieve the price setting. What we are talking about, that I should set the prices once we have the futures volumes, and definitely the price setting much more.
How does that volume come here? The fact is that they have already set up their exchange. It's already up and running, and it's garnering this kind of volumes. How are these exchanges, or how can they actually move the volumes from a COMEX, which is already established, to these new exchanges? How is it possible? Anshuman, can you throw some light on that?
I think that's a very good question, Ramki, because eventually, if you look at it, it's only two things that matter, right? One is the participants on that, because they are the ones who are going to come and trade and provide the, the quotes on the platform. And the second is the liquidity that comes along with that. Eventually, today, COMEX is being used as a reference point for everyone to go and hedge, because we know that there's a lot of liquidity there. If you want to do any large volume, there's a good chance that you will be able to, get it at a single price. Same thing happens with the OTC, and that's why London is so popular for all the settlements of the physical transactions. Eventually, consuming nations like India have an advantage because we have participation. The thing that we have to get in here is the liquidity. Liquidity is a factor of getting the right players, getting the right regulatory environment for it, and then creating. There's a lot of market making also which goes on it. Like COMEX also have market makers. Most of the exchanges do have or did have, whatever the case might be.
So the attraction of these players, the liquidity providers, is only going to start artificially in form of the LES, or is there any other way other than the LES?
It's not artificial, I would say. I think it's just a question of the first. Somebody has to take the first step, right, to get others to come on the platform, and that's how the OI is then built up.
Just to add, if we have to be a little bit ambitious, obviously, I mean, I agree with liquidity for any exchange is the key thing. Now these IIBX is all set. It's why not international players directly, and in fact, why not approach international exchanges to have a cross listing of? We have been discussing this in the past, that we can have a cross listing of contracts with delivery mechanism, because this jurisdiction offers the benefit of not touching the local taxes as a duty and GST. So it's like clean, get the gold here, trade, store, and have a. But obviously, I mean, the research has to be done. But we can always think that then get that liquidity much needed.
By doing this, do you think that there's a possibility of actually moving the players from the OTC markets, maybe their jurisdictions, into an exchange? That's a possibility.
Absolutely.
I think,
Yeah.
Ramki, just to add on this point, I think we as a country have a unique advantage that we are actually a consuming nation, and where historically people do understand the benefits of hedging in the futures, using futures also. We have had exchanges officially, and as Ajit was mentioning, for a very long time, and then now we have successful exchanges in the domestic market, which are evidence to that.
Do you think that the compliance costs for the market players, considering the fact that a lot of these players, whether it's India or whether it's overseas, they might consider that as a major aspect for being a deterrent to come on an exchange platform
Well, compared to OTC?
compared to the OTC?
See, OTC pricing has always been a little bit non-transparent. Okay? So if you compare with exchange price, obviously exchange will be much more transparent. Now you have to see in totality that how much are you paying for an OTC transaction in totality. That includes the funding period, and because in Indian context it will be consignment model, so you have premiums given dollars, whatever, which will include everything. And but then you are funding for the duty, those aspects. Here versus the exchange where it will be transfer. So you have to see in totality that what works best, and that's where the efficient exchange mechanism will come in the picture. Whereby if it is efficient, then cost will always be lower than the OTC prices.
Anshuman, yeah, you have something to say on that?
I was just going to add to what Ajit was saying. I think the other thing that you have to consider today is, if you see, for example, the volatility in the gold market and the way the prices have moved up by more than 30% the last 1 year, the counterparty risk element is also becoming very significant. If somebody wants to trade a large chunk, let's say half a ton or something, you want to do it on a proper, with a proper counterparty, or a body like an exchange, where it's much more regulated and it's much more transparent, and it's more auditable and everything, all those benefits that come along with it. Just to answer your question, the compliance cost is one part of it, but I think you also have to look at the other parameters to, and then decide on that.
I guess the central bank still will prefer an OTC model, right? They don't want an exchange platform at all.
No, I don't think that's
No,
the
I don't
case now.
think so. I mean, from a central bank perspective, the more transparent and efficient the market is better, because then in that case, and a progressive regulator obviously look for transparency, ready availability of reliable data. Okay? That's where a regulator will look at. So I think from a central bank perspective, I think they will prefer to have an exchange ecosystem in any country than having an OTC, whereby the oversight is not that easy as well as transparent.
Yeah.
Also, if you see on this point only, the central banks that you raised, even the OTC transactions that happen with the central banks is normally on the fixing, the gold fixing or the silver fixing, because that's a price which is identifiable and it's very transparently available. I think end of the day, that is what matters to them.
Anshuman, in fact, Ajit mentioned about shift of the market participants to an exchange-based ecosystems, right? Now, what exactly is happening in the COMEX at this point of time? What we are hearing is the premiums are going up. 20th of Jan is approaching. What is actually going on out there?
Well, I think this is all because of the new elect president in the US and his comments around the possibility of imposing tariffs there. There is a bit of a panic at this point of time, and obviously, as Ajit mentioned earlier, the number of contracts that are traded on COMEX on a daily basis are very high. So everybody who has a position on the COMEX or who is basically catering to various clients is trying to ensure that there is enough physical availability in the US should there be any chance of a tariff being imposed. So that's where the whole movement is happening, and because of which the EFPs have gone up, and not only the EFPs, in fact, even the OTC has been affected, because if you see the Stonex rates, the swap rates that we use, they have fluctuated by almost about close to 10% in the last 24 hours.
And how it affects, say, in Indian context, what happens is since we import, okay, if in consignment model as well, people are fixing the prices based on COMEX and EFPs. EFPs have jumped to whatever $30, $40, $50. I have seen $60 as well in the past. So it adds to the premium. Adds to the premium when you fix the price. It's your spot plus that kind of a price. So overall, the import number, it adds to that, because then the
trade flow actually moves back into the US. So you had the precious metals, which is currently probably stored in other locations, moving back into the walls of COMEX. That's what is happening at this point of time. Now, the fact is that whether impending tariffs or what, in a hypothetical situation, once the tariffs are in place, whether the hedgers or the potential hedgers, which could be producers or consumers, would they try to find alternative avenues of hedging? Is that a possibility, Ajit?
Well, alternative means either you go on the exchange or you have the OTC.
Either of it. So I guess that the OTC will be
exchange. We are seeing what's happening,
right?
Okay, and obviously those volumes will include participants. OTC is more on the physical side, right? So from a miner's perspective, anyway they are naturally hedged as such. So from an OTC perspective, they will not be inclined to use that, okay? And I don't think even banks will for the exchange mechanism from a broader global perspective. And so there are not many alternatives. In fact, forget our ecosystem, but any other markets also. There will be hardly any few alternatives to hedge such kind of a risk. So unless the best thing is not to be in the market.
Is there any opportunity for the GIFT City exchanges? That's what I'm posing a direct question here. Is there a possibility of that, some portion of the trade to probably being targeted by the exchanges here, or maybe even the OTC players here? I guess I put them on the fire.
No, that's not. What mean to say on the pricing side?
Yes, or maybe to actually deliver it on.
I think
in
currently what correct me if I'm wrong. What I'm hearing is that a lot of banks are pushing the metal out of India and getting into COMEX to get.
That's for the premiums. So that's until such time that the premium is there. Once the tariffs kick in, yeah, Anshuman.
I think, Ramkit, I think this is a scenario which we haven't seen for a while. I mean, COVID was a different time when we saw the inventories moving there because there's a squeeze of, there was a logistic handicap, and because of that, the markets moved, and there was a logical reason behind it. This is slightly beyond that, because this is more of something that could potentially happen. We don't know if it is going to happen. So the thing is here, it's not only about encashing the profit that you can get on trading on COMEX right now, but it's also a question about hedging yourselves also at this point of time. And not for today only, but for the future also. If you go out today to speak to any refinery, whether it's in Europe or US, probably their offtake, the refining capacities have been blocked for the next, not for the next 2 weeks for the expiry, but maybe potentially for the next 3 months now. So this has a wider implication than what we think from a trade perspective at this point.
Anshuman, with regards to the technological changes, whether it's OTC or an exchange, are there anything worth discussing as far as these two modes is concerned for the purpose of trading on platforms or algo trading, anything that is actually happening on the ground?
Overall, we've seen a lot of changes happening in music. Even if you see the way the exchanges function now, even IFSCA is a classic example of now being the only exchange in the world which does your trade settlements every 30 minutes. This is pure tech only. And algos have been there for a long time, but now the AI is also another important thing which actually feeds or provides the inputs to the algo. I think the tech is a very critical element of how we do business. So that definitely is evolving and has evolved quite a lot.
So I guess this is it from my side, at least in terms of what were the questions that I had in mind.
I want to go back to the topic which we discussed about central banks preferring OTC and exchanges.
Than the exchange, yes.
See, one point which I wanted to make is if I have, as a central bank, if I have one data source, okay, like in India, for example, and then we have 4 or 5 types of metal into the country, we have, say, one IIBX. The data efficiency probably will be much, and it will help in policy making as well. That one single policy, and I think that will but and now I think RBI has allowed banks also to participate. So I think it has the potential next vibrant.
I think this point that you have raised, Ajit, brings us back to a burning point that has been pending for several decades now. India has been a consuming country, for as long as we know. But in terms of the international market, when it comes to price discovery, the role we play is very small. I think the exchanges in GIFT City and the whole GIFT City environment itself actually has a potential of providing that platform where we can start having a price discovery for India per se, and who knows, someday soon we might even have our own fixing, just like how we have the rupee fixing.
So that's a concluding remark as far as Anshuman and most of us are concerned, because that's where we actually aim for in terms of price setting, whether it's the exchange or whether it's the OTC. Either ways, the Indian institutions, whether the banks or the exchanges, will have to play a vital role if we have to become a price setter. That's it from our side. Thank you so much.
Thank you. Thanks.
Little louder clap because they ended specifically on time. Thank you for doing so. And I now request Mr. Ashok Gautam, MD and CEO, India International Bullion Exchange Limited, to present the memento to both of them.
Well, we have been traders, all of us. That's how we started the career. So we understand the value of time.
Thank you so much for doing that. And we thank Mr. Anshuman Sharma for joining us virtually. Thank you. Thank you, gentlemen. For sure. For sure. Our next session is Vision 2047, ushering in a new era for gold. For this session, I would like to invite Mr. Sachin Jain, Regional CEO.